Right, now let us have a look at the bearish engulfing pattern. Remember, we had looked at the bullish engulfing pattern when we were looking at all the four bullish patterns: the hammer, the bullish engulfing pattern, the piercing pattern, and the morning star. Now we are looking at a bearish pattern, which is the bearish engulfing pattern. This is the reverse of the bullish engulfing pattern. Okay, so let's go over the basics, because this is where you understand the pattern and then we start applying this to multiple charts. We will also have a look at an example in this chart itself. So first, it is a 2-candle bearish pattern. The shooting star was a 1-candle pattern. This is a 2-candle bearish pattern. Must come after an uptrend. Of course, just like a shooting star, it must come after an uptrend. However, the shooting star ideally should come after a prolonged uptrend. The bearish engulfing pattern, even if it is coming after a short-term uptrend, that is fine. The first candle is a white real body. It's a long white real body, ideally, okay? The second candle is a black real body that completely engulfs the first candle. So the open and close of the black real body should be beyond the open and close of the long white real body. So the black real body should completely engulf the prior long white real body. So the market is going up, the bulls are in charge, and suddenly you see a bearish price action where the black candle completely engulfs the prior white candle. The first candle body must be as small as possible. Now, when I mentioned that ideally it should be a tall white candle, but imagine if the candle is this small. It represents that the power of bulls is diminishing on that candle, and suddenly you have a big black real body which is engulfing a small white real body. That is even more powerful. Okay, so the point here is if it is a small white real body engulfed by a tall black real body, that's a very powerful bearish sign. But even if it's a tall white real body engulfed by a even taller black real body, that's again a very powerful bearish engulfing pattern, because on one hand you see huge bullish momentum, on the other hand you see complete shift in psychology. Okay, so the first candle real body must be as small as possible. If it is small relative to the black real body, that's an ideal situation where you see a complete shift in psychology. The shadows are not much of a concern, because what we are concerned about here is the real body, whether it is engulfing the prior white real body. And we have seen the examples of this when we studied the bullish engulfing pattern. This is just a reverse of that. Okay. Now, let's have a look at an example. So this is Gale. This is a weekly time frame. I always like to look at the higher time frames, because the higher the time frame, the more is the probability that the trade will work out in our favor. Now you see the market ascending here. 1, 2, 3, 4, 5. 5 weeks the market has been going up. Five bullish candles here, and suddenly you have a tall black real body, which is what I was discussing. If we compare these two candles, look at the big difference between these two candles. The tall black real body is completely engulfing the prior white real body, which indicates a clear shift in psychology. It's also an N-shape pattern. So this forecasts an end of the prior trend. So from here the price is either likely to go sideways or completely reverse in another direction. So that's the bearish engulfing pattern. It's a very powerful bearish pattern. Of the 4 bullish patterns which we saw, the hammer, the piercing pattern, the bullish engulfing, and the morning star, The morning star was the most powerful one. Then came the bullish engulfing pattern. Similarly, in the bearish patterns, you will see 4 patterns. One is the shooting star, which we have already studied. Second is the bearish engulfing pattern, which we have looked at in the prior slide. And third is the dark cloud cover, and fourth is the evening star. So basically these are a reverse of the bullish patterns that we saw. So this is the second of the 4 bullish patterns, and this is the second most powerful of all the bearish patterns, because I think the evening star is more powerful than the bearish engulfing pattern. So that's the bearish engulfing pattern, where the black real body completely engulfs the prior white real body. So in this case, as you can see, the trade has worked out fine. Any short position taken here has resulted in nice profits. And if this was the stop loss, in this case the stop loss was hit multiple times. However, the candles were not able to close above the high of this bearish engulfing pattern. Okay? Alright, now let us have a look at the types of bearish engulfing patterns. Let's go into more details. See, all of these are bearish engulfing patterns, but the shapes of the black bodies and the white bodies are different. So in this case, it has the tallest white real body. This has little bit smaller white real body. This is the smallest of all the 5 patterns. This doesn't have shadows at all. But there is one thing common in all of these 5 patterns, is that the black real body completely engulfs the prior white real body. So this black body is completely engulfing the prior white real body. Again, in this, you see all these black candles are engulfing the prior white real bodies. So, and all of them are coming after an uptrend. So the bearish engulfing pattern can come in different shapes. So it depends on the market context as to how we analyze the market situation and how we take the trade. And we are going to look at multiple examples of that in this section on the bearish engulfing patterns. Okay? So all of these are bearish engulfing patterns, provided they are coming after uptrend. If they come after a downtrend, they are not bearish engulfing patterns. Okay? As we looked at in the shooting star. So this is the daily chart of Bajaj Auto. You have a nice uptrend here. Now, this is where the bulls are coming in. This is a bearish engulfing pattern. Okay? So this is where the bulls are coming in. So we can think of keeping our stop loss just above the high of the bearish engulfing pattern. The highest high of the 2 candles becomes our resistance. As we looked at in the shooting star, the high of the shooting star becomes resistance. Then you have the entry point here. So that's our risk. That's the risk that we are taking. But look at this bearish engulfing pattern, very strong. It's a small white real body and a tall black real body, where the bears are completely stamping their authority on the market here. And interestingly, it is coming at this 2,900 price level. So probably 2,900 level. It has 2 zeros at the end. So interestingly, 2,900 level is the exact place where 2 times the price has stalled. So maybe 2,900 is a very strong resistance point. But nonetheless, you have a bearish engulfing pattern here, which is stopping this uptrend. So we can expect the prices to go down from here. That's our first support area, whether that's where the price has turned. And as you can see, there are more than 3-4 or almost 5 days where they have built a support here, second one. So that is S2. So we can either aim at S1 or S2 when we take a short position. In this case, both S1 and S2 have been hit, and that goes to show the power of the bearish engulfing pattern. Okay, smaller the white candle, even better, because the smaller the white candle, it shows that indecision in the market. If it's a small white candle, it shows that maybe the bears are coming back into the market. And when it is followed by a tall black candle, it means that the battle has been finally won by the bears. Okay, so I would consider this as a very significant turning point in the market. We will look at more examples of bearish engulfing pattern in the videos ahead. Okay. Alright, now let us have a look at the classic bearish engulfing pattern. So you will immediately get to know why I'm calling this as a classic bearish engulfing pattern. It's a very rare pattern because it has no shadows. It's very rare that we will see two consecutive candles without any shadows. So it's a small white real body and a tall black real body. You can see the immediate shift in psychology. The market has been ascending, and suddenly a small real body indicates confusion in the market. It's like a spinning top, okay? So, and that confusion in the market is clear when you see a tall black candle completely engulfing the prior white real body. So that's why it's the classic bearish engulfing pattern. It's very rare, but when you see something like this, you know that on this candle, at least the bulls were in charge. But that bullish view is completely negated by this tall black candle. Now, let us look at this chart. This is a daily chart of Dabur. We are looking at a bearish engulfing pattern. Look at this. Now, this is not a classic bearish engulfing pattern. But assuming there are no shadows, what would be your conclusion? You have a very small real body after this nice uptrend. We have some small real bodies here hinting that there is no force in the rally. Okay, so very small real body and a tall black candle. Okay, all appearing at this level. Look at this resistance point. 1, 2, 3, 4, 5 days. 5 consecutive days, these candles have not been able to break this resistance created by these two candles. Okay, so that adds more weight to the bearish engulfing pattern. So these two candles are completing the bearish engulfing pattern. So it's a bearish engulfing pattern confirming prior resistance. And one disadvantage with the bearish engulfing pattern is that by the time the candle closes, the candle has made a very long move, which is what we discussed in the bullish engulfing pattern and the morning star as well. The problem with 2 candle patterns and 3 candle patterns is by the time it is created or by the time the last candle closes, the price has already moved down a lot. So in this case, we might take a short position here with a stop loss here and expect the price to go down. So that's our first profit target. See, that is reducing our reward to risk. Now this becomes our risk and this becomes our reward. Okay. So because it's a tall candle, it is reducing our reward to risk. So everything comes at a cost. Although this tall candle has increased the probability that the trade will work out in our favor, but still it has increased it has reduced our reward to risk ratio. Okay. Additional confirmation is given by the prior resistance, which none of these candles was able to either cross or break. Okay. Alright, now let us have a look at the bearish engulfing pattern psychology. So, as we have discussed before, there is a lot of market activity on the opening and closing of any candle. Especially, it's a if it's a daily candle, the opening and closing are the official openings and closings. So let's say that the bulls have bought here, or the bulls are already making profit because the market is in a nice uptrend. So by the time this candle opens, the bulls are very happy. And maybe there are more bulls being added to the market. So the bulls are very happy here. By the time the candle closes, they are even more happier because they are now sitting on this much amount of notional profit, assuming they are not out of the market. Okay, so they are sitting on this notional profit. Let us call it X. Okay, for those bulls who bought here, their profit is X now, which is notional profit. Now, by the time the next day opens, it has opened even higher than the close of the prior white real body. So here, the bulls are even more happy. So now their profit is, let's call this Y. So X plus Y is their profit now, those who bought here. Okay? But by the time the day has ended, the price has closed here. So the price has traveled a great deal now here. So technically, if you see, the bulls who bought here, their loss is only this much. Only this much. So let's call this as Z. Technically, if you see, their loss is only Z. But psychologically, if you see, their loss is X plus Y plus Z, because they have already seen the price go from here, travel all the way by X distance, and then Y distance on the opening, and then come back again, lose the X, lose the Y, lose the X, and lose that Z also. So even though the loss for the bulls here is only this much, but psychologically in their minds it's a big loss, and they would like to get out of that position as soon as possible. So that is the reason why the bearish engulfing pattern is so powerful. Once the longs here are getting, once the bulls get out of the market, who is dominant in the market? The bears. So that's why the price goes down. Also imagine the bulls who bought here. Imagine the bulls who bought here. Whoever bought here has lost this much. Whoever bought here has lost even more from here till here. So X plus Z. So that is why whichever way you see this, it is a very strong bullish pattern. Okay? That's the psychology behind why the bearish engulfing pattern is so bearish and why is it so powerful. So let's quickly have a look at an example here. It's a daily chart of Infosys. The uptrend started with this hammer. I will be uncomfortable calling this a hammer because of the upper shadow. Ideally, I wouldn't want an upper shadow. But nonetheless, the lower shadow is more than twice the height of the real body. So that's the hammer. That is where the trend started. It went up and now you have a bearish engulfing pattern. The black real body completely engulfing the prior white real body. So the highest high of these two candles becomes a resistance. So we keep our stop loss just above that. Then our entry point is the price at which the bearish engulfing pattern has closed. Then that is our risk. And then we can expect the price to go down from here, probably hit this point, probably hit this support. So this is our S1, this is our S2, because that's where the price has turned. So we have a nice bearish engulfing pattern for a short position. Only negative is that it is not confirming any prior resistance. Maybe we have to go back more to see whether it is confirming anything. But you look at the psychology from here till here, the bulls were happy. And suddenly you see this kind of black candle. Of all of these candles, I think this is the biggest black candle, which is making the bulls nervous. And then the price starts to go down. It creates something called as the falling window, which we have discussed before. The window is nothing but a price gap. We have looked at a rising window during our module on shooting star. That's a falling window. Falling window becomes a resistance, so it's even more powerful. Falling window is a continuation pattern, which says that the price is likely to go down even more. Okay? So the bearish engulfing pattern has worked very well here in pushing the price down. Okay. Now let us have a look at the strength of a bullish engulfing pattern. Okay. So in this case, you see multiple patterns. All of them are bearish engulfing patterns. So the question is, which one is more powerful? Which one is more stronger? Now this is very subjective, and listen to this carefully because this applies to all the patterns that we have studied now. I have not discussed this while I was discussing the bullish patterns because I wanted you to see more patterns first before we come to this stage. Now let's compare these two patterns. Okay. Now here you have a tall black real body completely engulfing a white real body. Again, here we have a tall black real body relative to the white real body. So the white real bodies are with a different size here. Now, if they are coming after an uptrend, we would say that this pattern is more powerful than this one because this represents some indecision. There is some confusion in the market. And if we compare these two candles, this candle is more powerful and more aggressive relative to this candle when we compare the relative strength of these two candles. So I would say this pattern is more powerful than this. But wait, what if this pattern is confirming prior resistance? And what if this candle is not confirming prior resistance? So if I say that, let's say this candle is more powerful, this is more powerful than this, but what if it is not confirming any prior resistance? In that case, I would go with this kind of pattern. Okay? So the strength of the bearish engulfing pattern, there is a condition to this. If we have these two kind of patterns in similar situations where both of them are confirming prior resistance, then I would say this one is more powerful because of the difference in the height of the real bodies and the strength with which the bears are breaking the back of the bulls here. Okay? The smaller the real body, the better. And the taller the black real body, the better. Okay? So it all depends on the market context. So that is why we are doing multiple examples in this program where we get to see in what context do we apply this important knowledge. So let's have a look at an example. So this is a very powerful bullish engulfing pattern because you have a small white real body completely engulfed by a tall black real body. The shadows are irrelevant. It's just that the black real body is engulfing the prior white real body. Okay? It's coming after a long uptrend. It is a daily chart of Tata Power. Okay? So that's a very strong bearish engulfing pattern because if the bulls were strong here, why is it that we have two long upper shadows? Okay? Even the shadows, even if we are ignoring the shadows, but if we look at this as two separate candles and not say that this is, and let's say we ignore the bearish engulfing pattern, just look at the shadows. What are the shadows telling you? The tall upper shadows are telling you that maybe the bears are coming back into the market. So even if someone doesn't know that this is a bearish engulfing pattern, just by looking at the shadows, he or she can guess that there is some problem at that price point. And have a look at this nice resistance created by these candles. Out of these two candles, there is not one candle that has closed above this red line that I have drawn. Although it looks like the market is going up, but look at the closing. This candle, which looks like a shooting star, it is not a perfect shooting star because of that lower shadow. I don't like that lower shadow. So, although this looks like a shooting star, it has not been able to close. It has crossed but not closed above that red line. This candle, even if it has broken even if it has opened above that red line, but it has closed within that, that gives even more confirmation to the trade, because whenever the bulls take the price up and fail to hold that resistance, fail to hold their bullish price action, and they come back and close below the resistance, that is where you know that the bears have attacked the bulls completely here. And look how the price went down aggressively because of all the confirmations that we saw here. Whenever the bulls try to break resistance and when they fail in doing so, that's a clear sign that the market is going to crash. Okay? So, and it increases the probability greatly that the market is going to crash. Probably 75 was the level where the stalling came place. 75 I think is a round number for this stock. Maybe 25, 50, 75. These are the turning points on this stock. It depends on where the candlestick patterns are appearing. This might easily have been 71 or 72, whatever. But the fact that it is coming exactly at 75 gives us a small hint to that this resistance might hold. Okay? Alright, now let us have a look at the special bearish engulfing pattern. This is a very rare pattern. We have also looked at a special shooting star, the special versions of all the bullish patterns. So this is also a special bearish engulfing pattern. You would see why I'm calling this a special is because the complete indecision between the bulls and the bears, the complete equilibrium between the bulls and the bears, the flat market, and then suddenly you have a tall black candle completely engulfing that small real body or doji, and all of this coming after an uptrend. It's an extremely powerful signal that the market is heading lower, because after a long battle, imagine this were a weekly chart. So after a 1 week battle between the bulls and the bears, they stopped here, and in the next week, the battle was completely lost by the bulls. So that's what makes it very powerful pattern. There is a lot of potential energy built up when this candle was created, and that energy gets released on this bearish engulfing pattern. So that's why I call it a special bearish pattern. You wouldn't get an exact pattern, but this comes close to that. So the first candle is a small white real body completely engulfed by a long black real body. It's appearing on a daily chart of LNT, so that it's coming after a steep uptrend. So that would make for a good short position where this is the entry point. The highest high of the two candles becomes our stop loss, and we can aim for the price to go down. Only problem here is the rising window that you see here. See that rising window we discussed in shooting star, the price vacuum. The Japanese call this a rising window. A rising window becomes a support area. So that is one reason probably why I would avoid taking this trade, because if you have a correct knowledge of candlesticks and windows and patterns, then you know where your support and resistance levels are. Okay? If you know that there is a support here and there is a resistance here, that gives you enough of hints about where the price is likely to go. So I would not take this trade in real time. However, if you see the price action which happened after that, so the bearish engulfing pattern is so powerful that it even succeeded in breaking this rising window in just 2 or 3 candles. So that was the bearishness of that bearish engulfing pattern. Also look at this round number. Because it is ending with 50, I call it as a round number. So maybe 1200 or 1250. This is, see, if you draw a line at 1200, see the stalling of the price. At 1250, you see the stalling of the price. So these levels, after an interval of every 50 units, is very important. You can't ignore this level. It's not 1201 or 1203 or 1206. It is 1200. It is 1250. So these are strong psychological round numbers where the prices are turning. So that's a second confirmation that maybe that will become resistance and the price just crashed, even though there was a rising window, which is a very strong support. The windows are the strongest candlestick signals, okay? And that 200 daily chart. So look at the power of the bearish engulfing pattern, okay? Right, now let us have a look at the non-bearish engulfing pattern. So for a bearish engulfing pattern, what are the conditions? It must come after an uptrend. The long black real body must completely engulf the prior white real body. In this case, it is not engulfing, it has closed just within the prior white real body. That is the reason why we do not call this as a non-bearish engulfing pattern. Moreover, the trend has to be correct here, because if the trend is not correct, if it is coming after a downtrend, then that is not a bearish engulfing pattern. A bearish engulfing pattern must come after an uptrend, and the black real body should completely engulf like a solar eclipse or a lunar eclipse, where it should completely engulf the prior white real body. If that doesn't happen, it is not a bearish engulfing pattern, okay? So in this case, since the black real body is not engulfing the prior white real body, that is the reason why it is not a bearish engulfing pattern, which is what you see here. So this is a daily time frame chart of Gale. It is not a bearish engulfing pattern, because look at the close of this black candle. If the black candle is not closing below the opening of the prior white candle, that is not a bearish engulfing pattern. For the bearish engulfing pattern, ideally I would like the white candle to be small and the black real body should be as long as possible. Although the trend is right here, but the candle pattern itself is not correct. That is the reason why I would be uncomfortable on this trade. I would wait to see what happens next in this price in this area, because yes, it is a bearish sign, but it is not enough to complete the bearish engulfing pattern. So I would not take this trade, even though it has gone down. But if you would have just shown me this chart, I would not have taken this trade, okay? So understand what is a bearish engulfing pattern and what is not a bearish engulfing pattern. I want the black real body to completely engulf the prior white real body, okay? Right, now let us look at another example of a candlestick pattern, which is not a bearish engulfing pattern. So if you look at this chart, this is IGL daily chart. We have to be able to avoid patterns which are not bearish engulfing patterns. Now, there is a nice downtrend here, and you see this chart, you see these two candles. It looks like a classic, or it looks like a perfect bearish engulfing pattern where the black real body, tall black real body is completely engulfing the small white real body. And the trading range itself is completely engulfing the prior trading range. The high and the low of the black candle is way beyond the high and the low of the small white candle, and it is completely engulfing the entire trading range, not just the body but the shadows also. So it's a very powerful bearish sign. However, there is one problem here. We discussed that a bearish engulfing pattern must always come after an uptrend, not after a downtrend. So for those of you who do not have correct knowledge, might think that, okay, we have a bearish engulfing pattern here, so let's take a short position here, put a stop loss here and expect the price to go down. Those of you who do not have the correct knowledge or correct understanding might make this mistake. So please understand that, as my coach Steve Nissen says, the trend is as important as the candlestick pattern itself, which is why I discussed in previous section on shooting star is that you cannot have a cheat sheet for Japanese candlesticks, because just by showing this kind of a pattern doesn't mean that it's a bearish engulfing pattern. It is also dependent on the market context, on what part of the chart is that pattern appearing. In this case, It is appearing after a downtrend. Okay. If you look at this, this is also, it's coming after a flat market. It's coming after a downtrend. That's not a bearish engulfing pattern. This is not a bearish engulfing pattern. If you would have taken a short position, see what would have happened here. If you would have gone short here, you are losing money here because you are expecting the price to go down. If you are thinking that's a bearish engulfing pattern, it is not a bearish engulfing pattern. So let me repeat that a bearish engulfing pattern must come after an uptrend. Here, the bearish engulfing pattern should come. Okay. Second, the black real body must completely engulf the prior white real body. So those two conditions are extremely important. If those two conditions are not satisfied, it is not a bearish engulfing pattern, and do not make the mistake of taking a short position in such scenarios. Okay? Alright, now let us have a look at the power or the strength of the bearish engulfing pattern. The bearish engulfing pattern is an extremely powerful bearish sign. This is one of my favorite charts in this section. I wanted to show you this. That's why I included this in the power of the bearish engulfing pattern. So this is a monthly chart. Okay, so I like higher time frame charts. The bigger the time frame, the more is the probability that the trade will work out in our favor. So you see how many candles here? 1, 2, 3, 4, 5, 6, 7. For 7 months, the price has been rising in this stock, and suddenly you see a black candle after 7 months of upward price action where the market is making higher highs. Okay. So the high of this candle is higher than the high of this candle. The high of this candle is higher than the high of this candle. So, and so on. So the market has been making higher highs. This is a steep uptrend. So the price has gone from say 320 something to almost 600. So if we extend this, that's 600. Okay. And exactly at 600, you have a tall black real body, which is completely engulfing the prior white real body. And there's a tiny white real body. After such 6 months of price action and after a tall white candle, you have a tiny white real body, that too on a monthly chart. That tells you a lot about what happened in that month. In that month, the bulls and the bears are fighting each other, and finally they did not arrive at any conclusion. So this is where the market was stuck. So we had to wait till the next month completed to see who has finally won the battle. So this might look like just 2 candles, but if you look at the time frame, it is 2 months. 2 months is a very long period in trading. So these 2 candles speak volumes about what is going on at that 600 price level. So this is our bearish engulfing pattern after 7 months of higher highs. So since the price has been pushed down by the bears from this level, let's assume 600 as our resistance point, because that is where the bears are sitting. That is where the bears are pushing the price down. So let's take the highest high of the bearish engulfing pattern as our resistance point, above which we can keep the stop loss. But I don't want to show you this in terms of a trade. I want to show you the power of the bearish engulfing pattern, how powerful that resistance point is even after months of price action. Okay. So from here, we started in some February 2016 and we went all the way 7-8 months. This is probably November. Okay. November, December 2016. So 7 months of price action. Then we go ahead. This is around November 2000, like October, November 2016 till this area, which is say June 2018. So that's a lot of time. Okay. So it's almost 1.5 years, more than 1.5 years. Even after 1.5 years, show me one candle here which has closed above the 600 level. Okay, this is purple dotted line. There is not a single candle which has closed above the 600 level. Not even this candle. This candle came very close, but it is not a decisive close. These two candles have opened at that point, but decidedly closed below that 600 level in that month. So some of the candles have crossed 600 level, but they have not closed the 600 level, which goes to show how important the resistance created by the bearish engulfing pattern is, even after so many months. Because 1.5 years, people tend to forget what happened 1.5 years ago. That's 18 months. It's a very long time. But no, the markets do not forget. The candlesticks do not forget what was the price last time, what was last time the price reached when it started descending down. So the market has a very strong memory. Remember that. Another thing is, if you look at these two patterns, let me remove this. If you look at these two patterns, what are they? This is another bearish engulfing pattern. This is another bearish engulfing pattern. This is one bearish engulfing pattern. So if you have three bearish engulfing pattern occurring at the same price point, which is a round number or a psychologically important number ending with 2 zeros, that goes to show how powerful that resistance level is, and prices are headed lower, which is exactly what happened for the next 4 months. The price has been falling. Remember, although these candles look small, but it's entire month worth of price action, which is the significant point here. That is why I wanted to show you this monthly chart. The higher the time frames, the more magic you see happening on the charts. What is this? That's a hammer which pushed the price up. It took months. It took months for the price to break the support created by the hammer. So not only are we looking at bearish engulfing patterns, we also look at some other patterns which we see on the same chart. It's not a perfect hammer because of that little upper shadow. If the body would have been slightly higher, I would have been more comfortable. But nonetheless, this hammer proved to be a very strong support area. So 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13. Almost 2 years, 1.5 to 2 years, that hammer held as support, and finally it was broken on this particular candle. So look how powerful these candlestick patterns are. They tell you the exact support and resistance levels, and your view is proved right if you consider this as a hammer and say that this is going to be support. Your view has been right for months and months ahead. Okay? Alright, now let us look at how the bearish engulfing pattern becomes resistance. We have already looked at multiple examples. Let's bring it into focus. The highest high of the two candles that constitute the bearish engulfing pattern becomes resistance. So now let's have a look at these two patterns. So in this case, the highest high of the two candles is this high of the black candle. In this case, the highest high of the two candles is this high of the white candle. So whatever is the high, that becomes our resistance, and we keep our stop loss just above that resistance point, just to have that extra protection. Okay? So the bearish engulfing pattern becomes resistance. So the entire bearish engulfing pattern becomes resistance, which is what we want to see here. So there is a nice resistance area established here. So this purple dotted line is not the resistance marked by this. I can draw a line here. So that's one resistance, R1. Let's call this R1. Then you have a bearish engulfing pattern. So this is purple dotted line. Let's call it R2. So now you have a zone here. Okay? Now you have a resistance zone created by these two candles. This is one, which is a shooting star. If this candle is this body would have been a slightly lower, it would have been even better shooting star. But nonetheless, the tall upper shadow more than twice the height of the real body makes it for a shooting star. Although I would have preferred that the body would have been slightly lower because we don't want a lower shadow in a shooting star, okay? So, but that's a resistance point because that's where the price has turned back down, okay? So that's our R1, R2. Where is our support? That's our support. So this is our support line, okay? So let's see what happens because we are saying that the bearish engulfing pattern becomes our resistance. So we want to see, we have identified our resistance and support levels. As professional traders, we know what the resistance and support levels are. So let's look at what's happening at these levels. Let me first draw the support line and then we draw the R1 and R2. Okay. So that's our zone. Okay. So this is R1 and the purple dotted line is R2. Okay. And this is S1. Look at the importance of these resistance and support levels. Okay. Now, after this, the market started to count down. These three candles tried to break that support level, but were not successful in doing so. This is a daily chart of Bharti Infratel. For 3 days, the bears tried to cross and break below that support line, but they were successful in crossing on this candle, but they were not successful in closing the price below that support line. Okay. So S1 held here. Now we go back from here. We go up from here and look at this candle. It stalls exactly at the resistance zone created by these two candles. One is the bearish engulfing and this shooting star. So it stalls exactly at that R1, R2 resistance zone. Then it starts to come down. Then the bears manage to push the price below that S1 and close it below S1. So the bears are happy. But by the time the next candle closes, look at the opening itself is so strong. There is an invisible bullish candle here. Okay. The opening from the here closing till the opening itself is so strong here that the bears were not able to sustain that bearish momentum. And the bulls were successful in pushing the price up and closing it back above S1. So that's the power of S1 here. That's where the bulls are sitting. Okay. Then the price goes up again and again it stalls at the resistance level. Okay. Then it comes down. Again, none of these three candles has closed below S1. Why? Because see, although it has opened below S1, but it is closed above S1. So the support one is still holding. Okay. Same, you see what is happening here. This is a bullish engulfing pattern exactly appearing at S1. This is another bullish engulfing pattern. Although here the bears again tried to close it below S1. They were successful in closing it below S1, but then the bulls came charging back again. So you can see how powerful that S1 level was, how many times it was tested and how many times it proved its mettle. Okay. Here, although this candle looks very tall, but look at the closing. The closing is within that zone. Okay. We are talking about a zone here. We are not talking about the levels. This R1 and R2, these were the levels which prohibited the price from closing above there. So it poked its head above the zone, but could not close beyond the zone. Okay. And we extend that further. None of these four candles were able to close above the R1, R2 zone. See, they have crossed, but they have not closed. Okay. So the bearish engulfing pattern becomes a very strong resistance point. So as professional traders, it's very important to mark these resistance and support lines that tells you what's happening in this, all of this randomness. There is some method to the madness here. Okay. So that is what we need to understand as professional traders. Okay. Let's have a look at one more chart of bearish engulfing pattern. I love to look at higher time frame charts. So this is This is weekly chart of Bosch. Okay, this is a bearish engulfing pattern chart. Okay, so you have a nice uptrend. It's a very strong uptrend because it's a weekly chart. Okay, one candle represents 1 week worth of price action. So if we have a bearish engulfing pattern on a weekly chart, it means that it has taken 14 days for that pattern to appear. Okay, so that is why, for that pattern to create. Okay, so that is why I would call this as a very strong bearish pattern. Okay, so how do you draw the resistance lines here? So we know that the highest high of the bearish engulfing pattern becomes a resistance. So that becomes our resistance line. If we think that this was our resistance line, that has been broken already, because you now have the bearish engulfing pattern and you have a new resistance line. So let me call that R1. So if I take a short position here and I keep my stop loss above R1, and I can expect the price to go down from here, and considering this as S1, considering this probably, if that was a turning point, then that would be S2. That would be a nice reward to risk trade. That's our risk. That's our risk. And that's our reward. If we are aiming at S2, that's our reward if we are aiming at S1. So a bearish engulfing pattern coming after a very strong uptrend. Notice that you have the 25,000 level here. This level might act as support. Okay, so that is one negative factor for this trade, because the candle has crossed that 25,000 levels but not closed below that 25,000 level. There is a big difference between crossing and closing of the candle. So crossing doesn't mean that it has broken that level. That's a very significant level. Okay, it's a round number, very psychologically significant number. Okay, so that's a good trade for a short position. Now the price itself is very high, so as a trader you'll have to see how do you take advantage of this position. Maybe you do options trading here, or you look at futures. That depends on how much lot size you are taking. Okay, so all those factors, all those things we are not discussing here. We are purely looking at candlestick patterns in this course and how to identify where the price is headed next, because it is very important to be able to read price action. The rest everything follows, whether you are a futures trader, options trader, intraday trader, that everything can be taken care of. And all of that, most of that information is available already on the free media, which is YouTube or things like that. But this is where we look at the basics of price action. How do we read the markets correctly? Okay, so in this case, it has given very good price action in the downtrend. So this is the weekly chart. So this resistance has held as this highest high of the bearish engulfing pattern has held as a resistance for multiple weeks ahead. Okay. Alright, now let us have a look at the entry and the stop loss system for the bearish engulfing pattern. This is pretty easy. By now you must know where to keep the entry, where to keep the stop loss. But let's bring our attention to that. So the entry is the close of the bearish engulfing pattern, which comes after a uptrend. Unless the candle closes, we do not have a bearish engulfing pattern, remember that. And the stop loss will be just above the resistance line created by the bearish engulfing pattern. So the highest high of the bearish engulfing pattern becomes our resistance line, and we keep our stop loss just above that resistance line, just to have that extra cushion. Okay, so let's have a look at an example here. So first you have this very aggressive bearish engulfing pattern. So you already have an established resistance line. So let me draw that line here. Okay. So that's R1. That's a resistance line. See, as professional traders, we need to be able to draw resistance lines and support lines properly. So this is a daily chart of HUL. Okay. Now this resistance line is holding because, see, this white candle broke that resistance line, but immediately in the next candle, it closed below that resistance line. So the bulls were not able to maintain their momentum. Immediately in the next candle, they pushed the price below this R1. Same thing happened with these two candles where it closed above R1, but in the next candle it closed below R1, so that R1 still holds. Then you have another resistance line which is 1800, which is a round number. I think that's the main resistance line. If you look at all of these candles, none of them have closed above 1800, which is a very significant round number. Ignore this 1946 that's coming from the later part of the chart. So 1800 level is an extremely significant round number or a psychological number. The bears are not allowing the price to cross that level or close above that level. See, this candle has crossed above that level but not closed above that level. Okay. So to understand the price action that is happening here, we need to look at the resistance zone, not the resistance itself. Okay. So now we are looking at a bearish engulfing pattern. Now this bearish engulfing pattern, I think one of the strongest bearish engulfing patterns you can see is something like this or something like this. They are similar, where the bears aggressively push the price down. So you have a very small white real body and the bears aggressively push the price down. You can't say that it's coming after a flat market. It is coming, if you look at the price action from here to here, it is coming after a nice uptrend. So that is a bearish engulfing pattern, which is confirming all this resistance zone created by R1 and R2. R2 is nothing but the 1800 area. So that is one thing. Second thing is the support. So that's our support, S1, let us call it. So this trade is not a good trade because if we keep our entry here, we keep our stop loss above the bearish engulfing pattern, above the resistance zone. Rather than keeping it above the bearish engulfing pattern, we can keep it above the zone itself to be more conservative. So that's our risk and that's our reward. So it is less than 1:1 reward to risk. So it doesn't make sense to take this trade. But if you look at the price action, if you want to understand the price action happening here, we need to understand what is R1 and what is R2. So I like precise levels. I like every R1, R2, R1, S1 I draw. This has a particular number attached to it. That's the price, whatever it is. Okay. This has a particular number attached to this. So R1 is equal to something, R2 is equal to 1800, S1 is equal to something. So I like precise numbers. Once I have those, then I can draw the resistance zone and see what's happening in that zone. Not a single candle in this entire chart that has closed above this resistance zone. There is one candle which has crossed above the resistance zone but not closed above the resistance zone. Okay? So that's how I look at this. Now this resulted in a very aggressive downfall. But whatever happened, I don't care. The only thing I know is that I wouldn't take this trade because the support was very close to the entry. I wouldn't buy near the support. Okay? Alright, now let's have a look at how do we set profit targets. We have covered this before, but let's bring it into more focus. So this is a weekly chart. Again, I am taking higher time frame charts just to show you the power of these candlestick patterns. These concepts can just easily be used on a intraday chart, like a 1-minute chart, 5-minute chart, 10-minute, hourly, whatever. But the weeklies give more probability. So I like to look at weekly charts So you have a nice uptrend here. Okay. And you have a bearish engulfing pattern, very tall black candle relative to the prior small white candle, which gives me that confidence to take a trade in the short direction. So a bearish engulfing pattern, but let's draw the resistance levels as professionals. Okay, so first is this purple dotted line. I extend it here. Okay, it is just above the 600 level. So that is our R1. Let's call it R1. So the highest high of the two candles creating the bearish engulfing pattern is our R1. Okay, R2 is the 600 level. This is where the price stalling has taken place. So the bearish engulfing pattern is respecting the R2, which is the 600 level, psychologically important round number, ending with 2 zeros. Okay, so maybe 600 is the level at which the price is turning. Then you have another bearish engulfing pattern here. See? Although not as aggressive as this, but it is still a bearish engulfing pattern. So we know that the high of that pattern always becomes resistance. So let's draw one line here. Let's make it R3. Okay. Now the shooting star that you see here is confirming the resistance, confirming R3. So it has crossed above R3 but not able to close above R3 level. Okay. So you have a bearish engulfing pattern, you have a shooting star, you have another bearish engulfing pattern which is even stronger than the prior bearish engulfing pattern. Even the shooting star high becomes resistance. So shooting star high is nothing but R2, which is the 600 level. So now you have a range. Now you have a zone. Okay? This is the resistance zone. This is where the bears are coming back into the market. So we now know where to keep our stop loss. So if I were to take an entry here, I would keep my stop loss just above this zone itself, because we know if the price starts to bounce back from here, probably it will enter the zone and go back, or it will enter the zone again and go back. Chances are very, very low that it will go above the zone. If it has to bounce back, it will bounce back from the zone itself. And you notice that the bearish engulfing pattern is confirming the resistance created by the shooting star itself. So the shooting star has become a very important resistance now. So that's our entry. That's our stop loss. So that's the risk. What's the reward here? The reward is this. I have already drawn the purple dotted line. That is where the market turned. And remember, this is weekly price action. Okay, every candle represents 1 week. So it's taken 3-4 weeks to form these patterns. So it's not a intraday 5-minute chart or something. So now you have a trade which is just less than 2:1, maybe 1.75:1 or something like that. Just by eyeballing it, you can say that this is not a 2:1 trade. So I would not be taking this trade. As a strict trader, I would not be taking this trade. But if you are comfortable as an aggressive trader to try to test this level, you can go ahead and do that, because there is multiple testing happening. Testing that has happened on that resistance zone. And as you can see, the profit target was hit here. That's the hammer, okay, which crossed that support line but couldn't close below that support line. Ideally, you would have wanted to get out at this hammer. You wouldn't want to wait till this hammer, because that's another 2-3 months worth of waiting time. But ideally, when you see this kind of a hammer bouncing aggressively at that profit level, at that target level, which is S1, if you see the bounce at S1, which is so aggressive, it makes sense to get out of the trade here. So from here till here, that's your profit on a short position. Okay? Alright, now let us have a look at how do we set the reward to risk. Let's bring our attention to the concept of reward to risk. So this is the daily time frame chart of Motherson Sumi. We are looking at how to set the reward to risk. So nice uptrend here. It's a small uptrend. It's not a major uptrend, but that's okay. We discussed that even if it's a small uptrend, that is still fine. So I keep my stop loss above the highest high of the two candles that comprise the bearish engulfing pattern. So I have drawn the stop loss level here, which is above the high of the bearish engulfing pattern. That's the entry level on a short position. And since this is where the price has turned, that becomes our profit target. So if we look at this reward to risk, maybe it's a 2:1, not exactly 2:1, 1.8:1 or something like that, just by eyeballing it. So I would not be taking this trade as a strict trader. I want 2:1, but for a quick momentum trade, you can think of taking a short position here with a stop loss here, entry here, profit target here. And there is no confirmation of prior resistance at that bearish engulfing pattern. So that adds to the low probability of the trade working out. But this was just to show you an example of which trades not to take. Although it has gone ahead and hit the target, but I wouldn't, in real time trading, I wouldn't be taking this kind of a trade. I strictly want 2:1. I learned this from my coach Steve Nissen, that if I keep my reward to risk as 2:1, that is quite acceptable. Even Steve Nissen is looking at 2:1 trades only. So that's a healthy trading practice. Reward to risk, as we have discussed before, is a very important concept in professional trading. That's the only thing that works in trading, because markets are very unpredictable. You never know what is going to happen next. So that's our risk and that's our reward. Although in hindsight, when we see the trade has worked out, but if you show me this kind of a chart, I wouldn't be taking that trade. Okay. Now let us have a look at the bearish engulfing pattern not confirming prior resistance. So we have looked at the standalone shooting star. Standalone means which is not confirming any prior levels. So that's a risky trade which we have discussed before. It's a low probability trade that is called aggressive trading. But since it is a valid pattern, some traders might go ahead and take the trade because they are willing to accept that amount of risk. So a bearish engulfing pattern that does not confirm prior resistance is a risky trade. Okay, so let's quickly have a look at an example. Now, as professional traders, we need to understand how to draw our support and resistance line, which you discussed before. So this is a daily chart of GBP INR, the British Pound INR. So this is a currency chart. We have looked at in this course, we have looked at charts of stocks. We have looked at commodities. We are also now looking at currencies. So the Japanese candlesticks have this universality principle where they can be applied to stocks, commodities, currencies. They can be applied to monthly, weekly, daily, intraday charts. And they can also be applied to any instruments, which is options, cash market, futures market. Whatever you want to do, you are basically analyzing the price, and Japanese candlesticks are a way to analyze the price action. So here we are trading the bearish engulfing pattern very aggressively. Aggressive because this bearish engulfing pattern pointed by this oval shape is not confirming any prior resistance point. Okay, that is one thing. Second thing, I have drawn this purple dotted line here because that's our resistance point. The highest high of the two candles becomes our resistance point. Another thing to notice here is that, see, I call this as R1. Another thing to notice is the rising window. We have discussed this concept briefly when we were studying the shooting star. So between these two candles, between these 2 days, there was a price gap. So it was a gap up opening on that day. So this entire zone, this entire rising window becomes a support. That is what we know. So this is not about S1 or S2. This entire thing becomes S1. Within S1, the lower line is more strong support than the upper line of that support zone. So now we have the resistance, we have the support. So chances are the price is likely to get stuck between the resistance and the support line. So as professional traders, if we know where the resistance and support are, then we can guess what is the likely price action that is going to happen. So if we look at these 4 candles itself, 1, 2, 3, 4, for the next 4 days, none of the candles has been able to either break and close below the support created by this rising window. So the rising window support is still holding here, and we have a resistance here. So the resistance and support are very close. So the price will likely to remain flat, which is exactly what happened. Let me draw that support again for you. So that's our support. That's the upper line, that's the lower line, okay? So ultimately it was this candle. So after so many days, you finally see some break in the market. So this was the first candle that broke that support. Again, that was not sustainable. The bulls pushed the price back up again within that support zone. But the resistance held. So this was an aggressive trade because, first of all, it was not a trade. For me, it was not a trade because I am taking a short position near support. Never do that. Even if there were not a window, for example, if the shadows were like this, so that's not a window because the shadows are still overlapping. There is no price gap, okay? Even if it was like this, then also I would not take this trade because it's an aggressive trade. It's a it's a high risk, low probability trade because it is not confirming any prior resistance area. Another important tip which I learned from my coach Steve Nissen is this 5-session rule. If you don't get the desired result, then exit the trade. So the point here is 1, 2, 3, 4, 5, within 5 candles. If I don't get my desired result, it does not mean that the price has gone ahead and hit your profit target. Desired result means at least the price starts to move in your direction for the next 4 or 5 candles. At least if the price starts to move in the direction that you have anticipated, then there is no need to exit the trade. We can still wait for our target to be achieved. But if it takes 5 sessions and the price remains flat at near the entry point where you bought, it makes sense to exit the trade. It is probably not going to give you those profits, which is exactly what happened here after 5 sessions. If you would not have got out of the trade, you are still stuck in that box range, okay, for another week and a half or so. So if you would not have gotten out of the market here, then your money would have been stuck in the market for quite a long time, okay? So remember the 5-session rule. If you don't get your desired result, or if the price doesn't move in your direction within 5 sessions, then it's probably not worth remaining in that trade. And this is an aggressive trading strategy because you are not waiting for any prior confirmation of resistance, okay? Alright, now let us have a look at the bearish engulfing pattern, which is confirming prior resistance. In the previous video, we looked at the bearish engulfing pattern not confirming prior resistance. So the bearish engulfing pattern that confirms prior resistance is a conservative trade. That is my type of a trade because I would like to see what has happened at that price point in the past, okay? So let's quickly have a look at an example of the bearish engulfing pattern confirming prior resistance. So we are looking at metals now, silver, 1 hour chart. So this is an intraday chart. So I have drawn a purple dotted line here, which is the resistance created at that candle, after which the price is just crashed. It just created a falling window, okay? So that's another bearish signal. A falling window is a bearish signal. That's the window if you want to see. Okay. Now, it's a short-term uptrend and the bearish engulfing pattern, tall white candle, tall black candle completely engulfing the prior white real body. Even if it is not above this like this, even if it is at that opening, that is still fine. I would still consider that as a bearish engulfing pattern. That is not a big problem. The point is it should completely engulf. It should completely, the closing is nicely below the open of the white candle. If this closing would have been within the body, then that would not be a bearish engulfing pattern. And the bearish engulfing pattern is respecting this support line, this resistance line. So now let's say I draw a line here, which is our R1, because the high of the bearish engulfing pattern becomes a resistance. The high, this has already been resistance before, so this is R2. So now we have a resistance zone here. Where would we keep our stop loss? Our stop loss would be above the zone. We can keep our stop loss above the bearish engulfing pattern. That is not a problem. But it's recommended or it's safe to keep it just above, because that is still a resistance line which has not been broken. There is not a single candle line from here to here which has closed above that purple dotted line. Forget about closing then. There is no candle which has even crossed that line. Okay? So that's our resistance. So the bearish engulfing pattern is confirming prior resistance, thereby creating a resistance zone. So you can expect the price to go down from here. However, I wouldn't take that trade. Why? Because of the reward to risk. If you take an entry here, that's your reward. And the risk is clearly more than that. Okay? So because of the poor reward to risk, I wouldn't take this trade. It's a 1 hour chart. It's an intraday chart. But look what happened. Even though there was a support here, the price continued crashing down. Is that a hammer? Yes, definitely, because the price has come down from here. Although it's one candle. Ideally, I would like to have 3-4 nice candles which brings the price down, creating a hammer. But that one candle was strong. It is a very strong black candle. So that is why I will call this as a classic hammer, not a normal hammer. I hope you remember the difference between the normal and the classic hammer. So the hammer failed to close below the support, so that support held, but it couldn't sustain because the bearish engulfing pattern was so powerful that the price kept on going down. Okay? So a bearish engulfing pattern confirming prior resistance becomes a very strong bearish signal. Okay? That's a conservative trade. Alright, now let us have a look at the price confirmation. We have looked at this model for almost all the patterns that we have studied till now. So, let's say there is a bearish engulfing pattern that does not provide us that resistance confirmation. Then we'll look for a price confirmation. So, a bearish engulfing pattern that provides price confirmation is an ultra-conservative trade. So, we'll understand this with an example. So, this is gold. This is a daily chart. Okay, we have looked at silver. Now let's look at gold. So this is a nice bearish engulfing pattern. The black candle wrapping around the white candle. So it doesn't provide any prior decisive resistance confirmation. So we wait for the next candle. So that is where we get our price confirmation. The next candle closes below the close of the bearish engulfing pattern. So we can expect the price to go down from here, keeping our stop loss here. Entry point will be this. The problem with price confirmation is if this candle is large, black candle, then we are selling at, we are taking a short position at an even worse price. So earlier our risk was this, now our risk is this. So again, we have discussed this multiple times that if we are waiting for a price confirmation, then we have to sacrifice on the reward to risk ratio. But price confirmation might be necessary sometimes if the bearish engulfing pattern is not confirming prior resistance. If it is confirming prior resistance, then probably we don't need a price confirmation. If it is confirming prior resistance and giving price confirmation, then that's an ultra conservative trade. You're waiting for 2 confirmations before taking the trade. But then all of that confirmation comes at a cost, which is the reduced reward to risk ratio. So in this case, see, this was an important high in the market for gold. Okay, look how the price has crashed from there. So it's very important to understand these kind of patterns. Very important to analyze where they occur and then go in the direction of in the market. One thing to notice here is that I would not have taken this short position simply because, see, there is a rising window here. Rising window is that price gap between the high of the first candle and the low of the second candle. So that entire window becomes a support zone. So if I wanted to take this trade, I would probably wait till this support is broken. Then I would be comfortable taking the short position. See, in this case, the window, this was the lower side of the window. The window was broken on this candle. So probably I would have taken a short position here and then expected the price to go down. But then look what is our reward to risk ratio. When you learn windows in the next program, you will, in the next level 2 training, you will learn that we can take the window and we can keep our stop loss above this. So that's a discussion for another video, another course, another section. But the moment this support was broken, that was a very clear bearish sign. But just by looking at this chart, I wouldn't take this trade. But to illustrate this, assuming there is no window here, that's definitely a price confirmation, okay? That is telling us that the price is heading down. Because if it would have closed within the bearish engulfing pattern, then probably the price would have gone up. We don't know what would have happened next, or the price would have gone flat. But the fact that it has closed below the bearish engulfing pattern, we can say that the price is definitely heading downwards, which in this case has happened. Okay? Coming back to our good old model where we look at confirmations and try to increase the probability. So this is trading the bearish engulfing pattern correctly. So if I have a standalone bearish engulfing pattern, that's a low probability, risky, aggressive trade. If I have a bearish engulfing pattern confirming prior resistance, that's a little bit medium probability, conservative trade. That is my kind of a trade. So, and if we wait for another confirmation, which is price confirmation, then that's a very high probability, but low reward to risk trade. So it's a low risk trade, but it's a low reward to risk trade as well. It's a high probability that the trade will work out. So as the probability increases, there is a cost to achieving that high probability, which is the reduced reward to risk. Let's quickly have a look at an example. That's a very aggressive bearish engulfing pattern. This is a daily chart of future retail. Now, if we look at this, we are looking at this particular scenario because this is not confirming prior resistance. So we may have to go back quite some time to see whether what has happened at that price level previously. One good thing about this is that the bearish engulfing pattern confirms a round number. So a number ending with 50, that's a clear psychological round number. So at a different 50, at a intervals of 50 units, so 500, 550, 600, 650. Probably these are important levels in the market. So, and this bearish engulfing pattern has failed to close above that 650 level, which is a nice positive sign. So that is a very interesting trade. So we might have to wait for a price confirmation because this is not confirming prior resistance. So if we take a trade here, let's say with a stop loss here, that's a very tall risk. That's a very risky trade. But can we have a reward which is twice this? Definitely. In this case, although the risk is high, but reward also is high, provided there is no rising window here. But yeah, I see a 2:1 trade here approximately. So it makes sense to take that trade if we look at it from that point of view. But since I would be someone who would wait for price confirmation, I would wait for this candle to appear. And then probably I would take the trade and try to aim for this support area. So that is how I would look at this trade. So to quickly summarize, first is the standalone bearish engulfing pattern. Second is the bearish engulfing pattern that confirms some prior resistance. And then third one is the price confirmation. So if we have a pattern which confirms the prior resistance and gives price confirmation, that's a very high probability trade. Okay? Alright, now let us have a look at our good old quiz questions. So this is a daily chart of Bharat Forge. Would you take this trade and why? If you would take this trade, why would you take this trade? If you would not take this trade, why would you not take this trade? Okay? So analyze the chart, pause the video and come back, let's discuss it. Alright, so as professional traders, we need to know how to draw the support and resistance lines. So first, is that a bearish engulfing pattern? Definitely it's a bearish engulfing pattern because it is coming after a uptrend and the black real body is completely engulfing the prior white real body. That's one. Signal number one is that bearish engulfing pattern. Okay, so let's mark it as 1. Then you have this resistance here. See, the price has turned here. So if I take that as my resistance point, then the bearish engulfing pattern has respected that resistance point. So this is a bearish engulfing pattern. Remember the second point, the bearish engulfing pattern confirming the prior resistance. My style of trade. Okay. So you have that extra confirmation now. And if we have to draw the support line, that's our support line. So let's say if I take an entry here, that's our entry. That's our stop loss. So that would be our risk. And this would be our profit target. So it is not a 2:1 reward to risk. So as a conservative trader, I would not take this trade because although everything else is okay, but the reward to risk for me is not okay on this trade. So I wouldn't take the short position here. But for an aggressive trader, if I have a candlestick pattern confirming prior resistance, definitely I would go for this trade without worrying too much about the reward to risk, because I am an aggressive trader. I want to go in the direction of the market. I want to ride the momentum. I want to ride the bearish momentum, which in this case has proved to be very correct. But I would not have taken the trade simply because the reward to risk was not satisfactory for me. But there are aggressive traders in the market, so they might take a short position here because it is confirming prior resistance and they may ride the trend all the way down. Okay? Alright, now let us have a look at another quiz question. So this time I am taking a weekly chart. So this is a weekly chart of Tata Power. Would you take this trade and why? And if you would take this trade, why would you take this trade? If you would not take this trade, why would you not take this trade? So that's the latest candle. That's all the information that you have here. So pause the video, think about it, come back to it, let's discuss it, okay? Now, let's see what's happening here. So you have a hammer, probably there is a nice downtrend here. So you have a hammer on a weekly chart, so that's a very powerful pattern. So it's a long lower shadow, easily equal to or more than twice the height of the real body. It's far bigger than twice the height of the real body. So that's a powerful pattern, which is why you see two very long white candles here, okay? And assume there is no rising window here, okay? For this chart. So assume there is no rising window here. And that unnecessarily complicates things. So after a nice uptrend, you have a bearish engulfing pattern here. Now the problem with this bearish engulfing pattern here is that it is a standalone bearish engulfing pattern. It is not confirming any prior resistance area. So I would be uncomfortable taking this trade because it is not confirming any prior resistance. I would probably wait for a price confirmation. So if I look at this candle, I would probably take a short position at the close of this candle. So if I keep the resistance or stop loss above the high of the bearish engulfing pattern and I keep my entry point here, so that is my risk. And what's my reward? I take the bottom of the hammer as my reward. So if I draw this reward, so I have I think I have a 2:1 trade here. If I draw the midpoint set, that's 2:1. So that would become a 2:1 trade. So if I were to take this trade, I would wait for that next candle to appear, and I would take that only if the reward to risk is in my favor, which is minimum 2:1. But as a conservative trader, I would not take this trade. Simply, if I have this as a conservative trader, I would not take that trade. But as an aggressive trader, definitely I would take that trade and expect the price to go down and reach this support created by the hammer. Okay? So to quickly summarize, as a conservative trader, I would not take this trade. As an aggressive trader, I would take this trade and ride the market down. As a conservative trader, I would wait for the price to close under the low of the bearish engulfing pattern, and then I would take that trade. Okay?